Welcome to another episode of Tank Talks, your personal think tank for all things startups and venture capital. I'm your host, Matt Cohen, founder and managing partner at Ripple Ventures. On today's show, we welcome Jeff Rinvelt, partner at Renaissance Venture Capital, to discuss how limited partners are thinking about the VC markets right now. Jeff shares his background on how he ended up in the investment industry and how he launched Renaissance in 2008 out of Michigan at the beginning of the global financial crisis. We dig into how Jeff and his team's investment thesis and deal flow sourcing have evolved over the last decade, and what Jeff thinks makes a great fund manager and long-term partner for his fund. Jeff shares some common mistakes and red flags that emerging managers should always avoid, and how fund managers should focus on transparency and over-communication with LPs. Finally, we dig into how Jeff and his team are trying to be great limited partners to their GPs, and how new investors in the venture capital asset class can mitigate risk and capture upside into today's market. But before we get started today, as our listeners probably know by now, the team at Ripple is always focused on helping our founders and portfolio companies find the best partners to work with. And when it comes to corporate finance and cash management, there's nobody we recommend more than the team at Jeeves. At Ripple, we manage all our fund expenses and employee credit cards using Jeeves. The team at Jeeves helped me get my team set up with physical and virtual cards in days. I was able to allow my teammates to expense items in multiple currencies, allowing them to pay for anything, anywhere, at any time. We weren't asked for any personal guarantees or to pay any setup or monthly SaaS fees. Not only does Jeeves save us time, but they also give us up to 3% cash back on our purchases, including expenses like Google, Facebook, or AWS every month. The best part is Jeeves puts up the cash and you settle once every 30 days in any currency you want, unlike some other corporate card companies that make you prepay every month. Listeners of Tank Talks can get set up today with a demo of Jeeves and take advantage of our Tank Talks special with a $250 sign-up bonus and skip the waitlist that already has thousands of companies waiting on it by visiting tryjeeves.com/Tank Talks. Use referral code Tank Talks to get set up today. Now let's jump into the tank for this week's episode with Jeff Rinvelt from Renaissance Venture Capital. Thanks for joining us in the tank today, Jeff.
Thanks for having me, Matt. This is great.
You know, Jeff, I really appreciate you taking the time to share your thoughts on the venture capital markets these days and how limited partners and funds like yours are assessing the investment opportunities out there. But before we get started, I would love it if you can give a bit of a brief background on how you ended up in the investment industry and how you ended up launching Renaissance in 2008 out of Michigan.
Yeah, so, I like to joke that my whole career has sort of been about diversification. Started off basically as an entrepreneur back in, the 2000s, sold a company to Netscape. So I had a little bit of exits there, and then went back to Michigan and had a couple startups there that basically sort of went nowhere. Actually had my first child born and went into venture capital. Got lucky and actually found a role in venture capital direct investing. So, went from one company investing to tens of companies per fund investing. And now actually in 2001, 2008, basically started Renaissance with my current partner now, and have like hundreds of funds per direct investments per fund basically segmented. So how Renaissance started, we were looking at raising our next fund and our direct side of it, and things were going great, but we sort of saw this new opportunity that had evolved from Business Leaders for Michigan, which is an organization inside Michigan with just the top 40 organizations, CEOs sort of sitting around a table. And they looked at it and sort of said the best way to create venture capital ecosystem around Michigan was to have a fund of funds instead of being a direct fund, sort of having a way of double multiplying your capital. They got together, sort of created a fund together, and they just didn't have the manager. So my partner and I sort of took their original thesis, crafted some things around it, and we'll probably talk more about that thesis as we go on. But that was sort of 2008. So what happened basically in the end of 2008? The fund got sort of cut in half. We figured out that we needed $40 million to survive because, again, the fees are different in the fund of funds world, so they're much lower. And my partner and I got $40 million, basically December 25th, 2008, made our first investment and have been off the races. We're now on Fund 4, still like 80, 100 million assets under management, about 300 million assets under management total, just total venture capital, early, late sort of side of it.
Wow. So you really did see the whole sort of a culmination of like early, startup growth, exit to Netscape, and then the sort of evolution of early stage venture capital, and then venture capital is like kind of a business. And then at the forefront of funds, I mean, your timing was great, but also terrible. How did you make it through? How did you make it through that 2008 period? With your partner and thinking about like we're still going to move forward while the rest of the world is falling apart.
It was a perfect time to actually investing in venture capital. I mean, looking back, I mean, it was scary, but we also knew that was basically the bottom of the barrel for venture capital. If you look at it, the median fund at that time was just doing S&P numbers. I mean, I know it was, but we sort of saw that was the down. That was it could only get better. And the other part of it was amazing too is that we had a pot of money when nobody else had a pot. There was capital calls that weren't happening. People were like, "Hey, you wanted my fund? Whatever you want to invest, please come to my fund." The other thing that sort of happened too was it's like, and we put our thesis together. We'll talk a little bit about theses, but that was the end of sort of the bio, of the bio. And it's been sort of straight and up and to the right until we've got the first two quarters of this year. That's been an amazing run, sort of to see that exits and multiples and all those returns that we're.
Interesting. It's like scarcity kind of breeds outliers because they would never be able to survive and become outliers, if there wasn't so much scarcity beforehand. So, I mean, can you tell us what your first investment was out of the first fund, and how did you guys go about even sourcing, deals and firms to invest in? And what was the original investment thesis, at the time you started the first fund in 2008?
Yeah, our first investment was sort of in our backyard and our friends that we knew. Arboretum is basically, block over, and their fund we knew basically that was going to be a good fund. I mean, there were some early signs, and they were, frankly, nice enough to let us in that final close of that. So we closed out our capital, made a capital call, and basically made a commitment sort of within 2 days of December. So everything was done very quickly once we had the capital side of it. You're right. It is, it is sort of, we didn't think a lot about sourcing. I mean, because again, a lot of it was just closing that capital. I mean, we frankly were very lucky because, you started hanging out on a shingle in 2008, beginning of 2009, there were a lot of people that wanted capital. You know what I mean? So, we talked to our friends. We had a lot of friends in fund of funds. We had a lot of acquaintances. We created a process and modeled after other fund of funds that we knew, but a lot of it was just sort of getting the world out there. You had capital, and you were either excited about venture capital or you were stupid enough to invest in venture capital with the returns you had, side of it. But you were hanging on a shingle. We've become more intentional, basically, over the time as we sort of have grown up. And sourcing for us is trying to attract people to Michigan, giving them deal flow in Michigan, sort of creating events around them in Michigan, and also just being sort of those early reads on the market. We've had some conversations, basically you and I, about what's happening in the market, what's sort of what's the best way to do things, sort of saying where is the LP market. We get to see a different perspective than you do running one fund. We have 26 different managers, so we see a lot of things about offices and valuations and other things that we get a larger read on than most individual GPs get to see.
Yeah, absolutely. I mean, that's why it's such a treat to get to talk with fund of funds, not just about like the capital commitment side, but just sort of like the 10,000-foot view of what's happening truly on the investment side, where their origination of capital is coming from and what their pulse in the market is, rather than just talking to another single VC fund. But what kind of fund of funds were you looking up to when you were kind of starting out and trying to model your framework after?
We were a unique model. I mean, the one innovation that we had was we were taking capital from large corporations, investing capital from large corporations, investing out of the balance sheet, which was not normal. I mean, and our whole LP base for the first fund was all large corporations in Michigan. So that was highly innovative. That was a new source of capital. So the NVCA was very excited about that as a new source of capital. And we can fast forward and see where that's coming. We now have sibling teams around the country sort of replicating our model, which is great. But we've also grown up too. And once we have a track record, we have LPs now which are much more institutional, sort of the foundations, the pensions. Those are LP based, and probably by dollar amount are the ones that matter more for us. But we still keep those corporations basically because they attract us back into, you as a GP want to talk to those corporations. The corporations want to talk to you as a GP because those are that innovation realm that they really don't. Even if they have a crypto venture capital firm, and a lot of these funds don't because it's a $5 million investment, and that's not going to create a fund for them.
Yeah, so you kind of act as a conduit for those R&D divisions at the large, corporates and conglomerates out there, which makes a ton of sense. But, given the fact that you've been operating for over a decade or more, you've obviously made you said, 27 fund managers right now. You've seen a lot over that time period. I got to ask, what makes a good fund manager and what makes a good GP and long-term partner besides just a good investor?
A lot of it goes back to what you guys expect from the direct investments. A lot of it is just open and honest communication. So we don't like surprises. We like to know when the next fund is coming. We like to know when your strategies are changing. We like to know what you're worried about, what you sort of see the changes coming down, and that's 99% of sort of that side of things. We also, again, for us, it's also Michigan is important to us, so it's sort of like we come up with sort of a plan for a fund on what they should do, sort of going forward to engage in Michigan and sort of doing what you're saying. If you're not going to do what you're saying, you should sort of give me an early reason why and start to communicate why those are happening or things are changing. If your thesis changes, that's another thing you should start communicating basically early and often to things. But a lot of it is just that open dialogue. We're a long term partner for you, basically, side of it. And then when that trust breaks down, that's when things start to go wrong and you have to rebuild it.
Yeah, I think some of the early conversations I remember having with you, even around our first and second fund, was, over communication, transparency, authenticity with regards to what you're reporting, and then just like not trying to like completely pivot the strategy off course just because that's where the red hot opportunities were, is something that you also shared with me, which I remember very early on from our conversations. But you kind of answered my next question, but I'd love to pull on it a little bit more, which is like, I guess, what are some of the red flags for some of the earlier, people in their career, such as myself, emerging managers, even though I know you don't really back emerging managers, that people should be aware of that will really scare off LPs in this market?
Everybody sort of has their pet peeves. We talk about funds just like you guys talk about corporation, investing in investments. The biggest one for me is just a strategy that's way too big. We're seeing definitely the better funds are the ones that are much more honed about the investment thesis. And again, that doesn't have to be fully built in fund one, but it should grow and evolve. And as you grow and evolve, usually that means specialization and saying, okay, I'm an early stage investor in SaaS businesses. Sometimes it even gets specific for SaaS businesses for these corporations. Have a well-honed thesis is important. The other things that are just sort of the easy things, which I think and most GPs know, is like philosophers without explanations. Those are bad things. Not having the math add up. Sort of side of it. It's like, I know if you're doing 50%, follow on, and you want to make 25 investments, and you've got a $40 million fund, that you're going to have such slow ownership. This is not going to be based on a fund that's actually going to return even money if you have multiple unicorns in your fund. So there is a math that basically goes along, and it's the same sort of things you guys look at, where it's like the P&L really doesn't work. You don't understand your expenses. You don't understand the business. You guys should understand the investments and understand how you return that capital basically coming back to us.
Yeah, the math and how the sausage gets made is really important. Just like you said, like even with our portfolio companies, we had to sit down with two founders the other day about how their commission structure and their bonus structure was basically letting 30% of their revenue walk out the door day one when a contract is signed, even before they take into sort of gross margin calculations and things like that. So, it's really important for you to understand the math on your own fund. And yes, it's great to have unicorns, but if you only own, 25 basis points of them, it doesn't really matter. And so for us at Ripple, we decided to be very heavily first weighted in our checks with a 70-30 model, and then just let LPs do the follow-on investments after a Series A for a co-invest with no fee, no carry as well, which I think has worked really well for a lot of our our institutional and family office LPs. But, just kind of pulling on that a little bit more, like what's more important to you as a fund to fund manager? Is it track record or technical chops at the, sort of emerging stages as a GP?
Yeah, I think we've had these conversations before too, and it comes down to a story I like to tell. Basically, saying, I got in a room with LPs that are much larger than us, that have large portfolios, and again, this is sort of the days where basically you handed out the deck. Basically, I watched everybody else in the room. They flipped directly to track. So, technical chops usually only last for one fund or two funds or three funds. So a lot of times, I mean, you've done a great job, sort of. I mean, you're obviously a great marketer. You keep technology, but your knowledge now is probably much more around being a venture capitalist, and you should have that knowledge around the capitalist. So you may have people that you pull on basically to augment your understanding in marketing or sales or technical chops, all these other things, but your track record is what you are, and past performance does equal future performance in venture capital. I mean, there's been a number of studies basically that's highly correlated. So yes, I care about track record.
No, it's good for you to say that. I appreciate your transparency, Jeff, in saying that a good story can only get you through like the pre-seed and the seed stage. Eventually at the Series A or beyond, you need to have a track record or some type of quantitative metrics for people to chew on. And it's funny because when I started the fund, I was starting right away with track record, my own angel track record, and then some of the early wins that I had as well. With the first fund, the sort of storytelling aspect didn't really come into fruition for me until I saw other GPs raising capital on just a story with no track record. So I figured I had to get a bit more of a story there. I did it the reverse way, but it's interesting to hear you say that like eventually, everything comes home to roost, and track record really is what people can keep their job on, especially on the fund to fund side, right? You're not going to lose your job if you make commitments to Sequoia because they have such a great track record, or all the other top tier firms. But it's at the earlier stages that you're also betting on a story, just like in startup direct investing. So I appreciate that. Just flipping the script here a little bit, Jeff, what are you doing as an LP to make you a better LP and to help add value to the other GPs out there that you back?
Yeah, I think we touched on this a little bit. The table stakes are understanding the market. We should be able, to talk to you about what's happening in the LP market, what we see sort of the consultants doing, where your market is going. And I think that's just the table stakes. The things we're doing different, the things we can be as differentiators, and what we're sort of, built differently for is those connections back to those corporations. And that's what I'm sort of betting on that will allow me to get that allocation in that fund, basically, when you've had of hitting it out of the park for two or three or four funds. And then I leverage that basically side of it. So I also leverage it a lot to sort of make the connections back into Michigan. We sit in a unique position where we're sort of Switzerland inside Michigan, where we have access to all the sport organizations, we have the access to all the other LPs side of it, and we do things called on demo days where we sort of twice a year virtually, and now we're going to have it in person October 12th this year, where we have this double opt-in. Funds come in, apply for that. Then we send it out to all of our GPs and our LP base. They sort of allow to say, who do I want to meet with, and from that we can sort of tell who's the important funds or who's the important companies, startups that are going to be presenting at them, and we put a hot list of this. So we're trying every way to sort of keep in touch with you in front of your face, and also leverage those corporate connections to say, you want to talk to Ford, you want to talk to GM, you want to talk to Meyer, those important people inside our ecosystem.
I love that. I mean, that's really great to hear because, when I speak to a lot of the US fund to funds, I always say to them, like, what can you do to make me a better GP? And some of the best, responses or things like you're saying is like, well, we do a semi-annual conference with all of our GPs to get together in the room. So that's kind of like your own kind of Kaufman, offsite, or you have a lot of these like crossovers between like your LPs into your fund to fund can get connected to the GPs that you're backing in terms of like, corporate partnerships and things like that. So I love how the fund to fund, the institutional funds are leveling up to make the GPs better rather than just being a source of capital, just like they're asking us as GPs to not just be a source of capital to our startup founders, but to be more than that and give a platform for them to stand on, which it sounds like you're building as well.
Yeah, there's a lot more to do there. I mean, it is as competitive yet as it's been in the VC space, but that time is coming. And again, for the better funds, we are competing for for getting in that fund, and also then to keep our allocation. I mean, a lot of these funds sometimes have sure said we're gonna stick with our knitting and basically stick at a certain fund size. And so we've gotten some cases where we're fighting for allocation or to keep our allocation. So we're auditioning every day basically for certain GPs to say, this is the person I want in the room. This is the person I want in my LP. This is the person I want to be close to. And we'll do everything that we can to sort of keep that allocation in the best manner.
That's amazing. So let's switch a little bit to like what's going on currently in the markets. One, how have you been navigating the sort of early stage market for manager selection in these current markets? And two, what kind of returns are you underwriting towards in these markets?
Yeah, I mean, it's been a weird time. And again, we all know this is a weird time, basically. But there were the first quarters of this year. There were, we probably did 2 years worth of deals in one quarter this year, and then it dropped off a cliff, basically quarter three now. So it's very interesting to sort of see that all this allocation sort of got eaten up. We're sort of seeing a denominator effect, which is that these large allocators have public stock that dropped a lot, and their private stock hasn't dropped that much or hasn't been sort of reallocated, basically, that unrealized yet. So, a lot of times they're working with still quarter one, quarter two data. So we're seeing a rebalancing happening. And most people are sort of saying that we're going into 2023 now for allocations, basically. So it's a very interesting time, and I've never seen it slow down that quickly, speed up so quickly and then slow down so quickly. So we're even seeing really great funds with really great track records that initially first quarter could have raised a fund with one and dones, now are pushing basically to 2023. So we're telling a lot of people, it's like if you want to close now, you may not see the same market traction as you may see in the early 2023. So if you can do it, push it out. If not, close it, get it done, start moving on to the next fund. We're also seeing, investment cycles that were very slow, very, very quick, now starting to slow down. LP calls are starting to slow down. And so we're, hopefully we're going back to more of a pace where it's less, every 18 months to a year, and maybe back to a little more, sane 2 years, 3 years sort of, investment cycles and re-upping of funds.
It's interesting. You were saying you did 2 years worth of LP commitments in the span of a quarter.
It was 2 quarters, effectively.
2 quarters. Okay, effectively 2 quarters. But was there any, pause, obviously, with you and your partner saying, like, should we try and resist the urge to deploy this capital this quickly? Or we just think we're going to be able to raise it on the back half at the same time as it's going out the door? Or was it just sort of like we need to just keep up with the deployment cycle that's happening, or we're going to miss all these opportunities? Like, what was the inside baseball conversations you were having with your partner at that time?
Effectively, we're always evaluating managers. I mean, we've had a bit of a pause now, so we're always evaluating managers and trying. Here's my A team, here's my on the bubble team, and here's these people that we're not going to invest in. So that decision, is happening all the time and should be, sort of our bread and butter. But you're right. I think, a lot of it was basically just to keep up. I mean, these are our A managers. We know we want to keep with them. We know we want to commit with them. And if we lose our place in line, we're not going to be able to get back in again. So, there's a little bit of that, and I think we've been able to fundraise. I mean, again, there's our backers, our LPs, LPs also side of it too, have told us it's like, hey, we will commit to your next fund. This is what we're committing. This is what important side of this is important us also. So we believe we can fundraise, and we also believe we want to make sure that we maintain those managers that we think are important to us.
No, that makes a lot of sense. You got to keep your spot in line, or else you may lose it for the next 10 years, which is not what kind of business model you guys are operating in. That totally makes sense. But my second question is sort of what kind of returns are you underwriting for now in these markets, given where the public markets are also pricing companies as well?
Yeah, again, we're looking for top quartile returns based on Cambridge numbers, and again, those float numbers right now, they're a pretty, if you look at the numbers now, they're I mean, those net IRRs quartiles are just you can go look it up right now, but they're not they're not insane. They're not important or not interesting numbers that I don't think they're going to be real. Basically, when those numbers become basically 7-8 years now. For us, it's mostly usually 20-30% net IRR. But again, if we go back to 2008, I'm still going to judge those managers based on what those Cambridge numbers say, because again, I want those quartile returns in the Cambridge pitch book sort of numbers. So, and again, I also said this, like, net IRR is important to us. I mean, I will talk multiples, but that usually translates into no value, because that's how I have a preferred return. I'm trying to return money. I'm getting judged on a net IRR. I have to judge my managers on a net IRR. So.
Speaking of, that's interesting. So we have a preferred return on all of our funds. It's around 6%. But it's not very common, though, that other VC funds have preferred returns. But it is common for fund of funds to have it. No.
Yes, very, yes.
So then, why are other VCs not being asked to have preferred returns?
And it might. I mean, that was something that happened. Usually, earlier funds, again, when they're trying to be very LP friendly, they will do certain things. Preferred returns is something that we really like. As a fund of funds, most LPs friendly. That's an LP friendly term. And as you're early, that's a very good thing to sort of have in there. As you get older, and as you get more of a track record, you can start to pull back some of those things that become more GP friendly. As we go back into a market that may be much more sort of LP friendly, we may see some of these returns, basically trying. The other ones that we're not, we're fine usually with, but some things that you might see is the carry going up after a 2x, after a 3x. Those things are GP friendly. I'm less concerned about that. Some LPs are concerned more about that, because again, that eats into our profits.
Yeah, we don't have any of those sort of ratchet or whatever accelerators on carry, but I can see how if you build the track record, you eventually can ask for those things. But in the early days, when you're building a reputation and a platform, I don't see how that really leans to your advantage. Given all the sort of fund managers that you've backed, you've seen a lot, in this current market. If there was going to be a new, investor coming to the table, or new LPs that want to get into the venture capital, industry as investors like yourself, but more maybe as direct family office or, single LPs, what advice would you give them to mitigate risk and to make sure they capture as much upside as they can in today's market?
Again, we talked about this, but look at a track record. Again, you were, I think you were more intelligent. This is sort of why we society is I like people to present, even if it is an angel list, even if it is a list from another prior investor that's attributable. I think that matters a lot. I mean, the story matters, but I think it matters, less than, it's like, okay, here's a story, but here's actually how I executed on that story. Here's how, my track record jives with that story and that my new thesis, and these are the investments that are around that thesis. So, a lot of times we all get excited about, even in startup land, we get excited about the stories, but numbers do matter in this, and these are long relationships. So you might as well, track those numbers and understand those numbers going into it.
It's so hard though, Jeff, and I've had this conversation with so many other LPs about what are the true numbers. I'm an LP through my own family office and half a dozen funds, and all the time I look at the numbers, I'm like, these don't make sense. I mean, you're taking a 7x markup MOIC on a safe note or a convertible note that hasn't converted. You haven't accounted for dilution. Like, there's no standardization across what actually should be reported to LPs or potential LPs. We've taken the extreme conservative approach in only marking up when a third party priced equity round happens and accounting for dilution and all that around. Why hasn't there been a standardized way in terms of reporting real metrics or track record to LPs yet?
A lot of this is just GAAP. I mean, 409 happened. I mean, I'm old school like you were. I ran a fund basically in the old days, when it was, you only marked the round basically coming at. When 409 happened, the auditors, or the big three auditors, or the larger auditors, were pressuring VC funds to market quarterly, definitely yearly, and they were pressuring them if there was multiples or a SaaS multiple, or there's something they could sort of do to float that number, they were pressured basically to do that. So we actually, I mean, you are at least in our portfolio, you're the exception to the rule. We're seeing probably 80% of our funds are marking to market quarterly and doing things around valuations. Again, 7x on the safe. Again, it's we're looking at those valuation policies as an LP pretty stringently now. So, and we're making sure that they're applying them on the good side and also on the bad side. So again, we've had 2 quarters, and third quarter is probably not going to shape up to be amazing either, of down rounds, or down things that should be down rounds, especially if you're marking up to public markets. Are you applying that in the bad cases and in the good cases and being consistent around that? And we've seen a lot of times where managers have gotten over their skis, new funds coming up, they don't want to mark down things. Will they be able to take that bad news at the same time as they've been taking the good news when the markets were running up?
Yeah, interesting. I feel like at the early stages, when the waterfalls aren't that high, the pref stack is low. You should probably use the last pref price if it was a priced round on a preferred share as the value of the current company. But as you move up into the later stage rounds, I'm wondering why people should just not default to the 409A, because that spread usually collapses from the 409A to the preferred price as they get closer to the IPO or the conversion. But I assume that's not going to happen anytime soon, given how probably wide the 409A valuation is versus the current public market expectations are as well, right?
Yeah, I think your analysis is correct. I mean, we've sort of seen a lot of these, everybody's sort of marking up on different multiples. I mean, it seems like sometimes the public markets were taking, indications from the private markets, and the private markets were taking indications from the public. I think we are sort of in a time period where things are more, more getting, or we're in a correction period, basically, where these private unrealized valuations are coming back. And, I'd like to see something back to normal, and that was some of the we alluded to this, but some things for us that were warning signs were when they were doing some of these later stage funds or even early stagers funds were doing multiples at revenue multiples that really didn't make any sense to me as a rational person. And they, most of the managers were honest about that. They were saying that they could earn their way out of it. That's a really tough business to basically earn your way out of. 100x multiples we saw in some cases of revenue. That's just a really tough, and everything has to go correctly. And we know, we all know that never everything goes correct.
Absolutely not. Shit hits the fan 99% of the time, that's for sure. But I think
Yes.
one lesson I learned from speaking with you and some other LPs was that we actually started reporting not only the multiple of ARR we paid on entry, but where the current ARR is and what the implied multiple and the current valuation is, so that they can get a sense of is this even a realistic valuation for what they were just given on a new round, based on where their ARR is and how that's changed over time. So we've been super transparent on how that has also evolved. Because if a company's ARR has not changed, but their multiple has gone up, people might say that's not really logical. I'm not going to take that markup or not really believe that markup. So I hear you there. So thank you for sharing that. One other thing that happened over the last couple of years, it's maybe slowed down a bit now, was this, explosion of the opportunity fund. What was your perspective of these opportunity funds? And do you think they present a good product and opportunity for LPs like yourself?
I'm not somebody that's investing in LP, in opportunity funds. I've had to do some of them because a lot of times there's been sort of, do the core fund, you have to do the opportunity fund. Sometimes multiples or certain reasons, or they'll let you only in the opportunity fund, and then you might get a seat at the table. Again, I don't see anything wrong with them. Again, they're a very good evolution of this, of the special purpose vehicle, but they're not for me. They're not the return profile I'm looking for. They're not sort of the deal flow I'm looking for. Again, but it doesn't mean that's a bad thing. I will look at it basically as a return. If you have that, you should sort of present that basically with your core fund and the returns on those things, because again, at some time the market may come back, and then we've even seen there's some of them where they're blending the core fund and the opportunity fund as one big fund, because they're sort of seeing 89% of the LPs are in both funds. Why the heck am I fundraising for two different vehicles?
Oh, interesting. People are blending that. I didn't know that you could do that. So for us, if we have an SPV from a pro rata check that was written in a fund one or fund two investment, those are treated as separate reporting, separate allocations on our investor portal. They're not overlap at all, even though the overlap in LPs is almost 100%. I've never actually heard that you can even blend those two in terms of like reporting and updates, but interesting to hear you say that. You do have some direct investments, I believe, or is it all just fund to funds? Because I thought you had some direct perspective as well.
Yeah, I did do direct investments. My first two funds, frankly, I wasn't good at it. So the last two funds we haven't had direct investments. I'm still excited about some of the core plays we still have going forward. But for me, it was sort of a choice between doing another fund, which I know I've been doing well. I've built a team for. We're just a small team, so it didn't make sense to continue. It may come back at some point, but I haven't been as excited about direct investing as a lot of other LPs, which I took to are very excited about.
So that leads on to my next question. When you are presented with co-investment opportunities as an LP in a fund, do you offer that to your LPs in your fund to fund, or you just always pass on those?
We have again. I mean, this is a lot of the times, and maybe you've seen this too. There's sort of what they want to do and what they're actually built to do. The velocity and the speed at these deals have been getting done. A lot of times these large corporations, these large LPs just weren't built to move that quickly, and they have compliance, they have all these other things that basically get in the way of moving that quick. So where they may say they want to do that, they may say they want the return profile. The truth is they're usually not built to do that. So we haven't had a lot of success. Again, these may change as the market slows down. I'm very happy if that comes back, but we haven't had a lot of success, or we haven't seen sort of those actually getting done.
Hey, that makes a lot of sense. Stick with what you're good at. Just like us, we don't want to follow on into Series B and C and D. We were seeing a lot of, emerging managers write their first check at a seed stage, and then all of a sudden the company shot up to $1 billion valuation, and they were still writing checks into the company, which is a totally different game. And I feel like people feel just because they knew the company at the pre-seed or seed stage, they now know that it's still a great investment at like the Series D stage. It's a very different risk profile that you're underwriting towards that you should be aware of, which it sounds like you learned early on in your first two funds. So thank you for sharing that. I got to ask though, what investment categories are you most excited about these days, given what's going on in the current markets as well?
Yeah, I don't think this is going to be any big revelation to anybody. These VCs on the side of it. Again, we're a fund to fund, so we're looking at things in a much. We don't talk about portfolio mix, but we're 40% IT, 40% healthcare, and then 40% sort of other market, which is emerging markets. Those are for me as sort of a little bit of agriculture, a little bit of material, advanced materials. We do keep sort of playbooks. We do, internally when we have some downtime, we do research on things that might be interesting to you. But again, they're pretty large buckets. I mean, agriculture is one that I've always been excited about, and never have done a dedicated fund, but have done things around the edges. Automotive, again, where we're at, that's very important, side of things. But again, things that excite me still are probably quantum computing, some of these edge computing things, deep tech, again, is a large category, or green tech, or whatever you want to call that. Basically, that's one of those areas we're seeing a lot of funds coming at us now, and they're very interesting to talk to. We'll see where they sort of shake out basically in the next few years.
No, that's awesome. We're a small team too, Jeff. And one of the things that I implemented early on was this show and tell portion of our Monday partner team meeting, which is the first 30 or 40 minutes we just dedicate to showing and telling interesting things that we either read, listened to, or watched or saw like online that we want to just sort of share with the team and then talk about it. It's like a very open, like, kindergarten show and tell, exciting things that we're passionate or excited about that could be totally irrelevant to the fund's current investment strategy. But it's really worked well to kind of pique people's interest between what they may necessarily spend 90% of their day on and the other 10% they're like excited or passionate about. So I thought I'd share that with you in case that's something you and your partner want to start doing, show and tell.
No, I love that. I mean, yeah, we do that very informally, but I like the formalization of that. I may steal that. We see a lot of, especially the biotech funds, where they'll present a paper. I mean, we've got a lot of funds that basically will do that because the research is so in depth and they're so specialized that they'll take a paper, take somebody, take a professor, take a category and present that partnership. So we see that haven't actually seen that sort of on the SaaS side of things. And again, it can be sort of all over the board. We're people that, the business isn't just the side of it. The things around the edges might actually be the more interesting things, and how those affect that knowledge and how we actually do business.
Absolutely. Yeah. So Jeff, you've spent so much time in this industry. I got to ask, what's the best career advice you've ever received from another LP in the space?
I must be simple, basically, sorry, because it's something that seems really obvious, but we keep talking about this. My partner and I, we've had some other LPs, and we have one LP in particular. Is basically we keep coming to them, and they're even on our advisory board, and they keep saying, if you're not excited about a deal, don't do it. Again, it's very simple, very down to earth. But even on re-ups, a lot of times, we're inclined to do a re-up, but if we're not excited, we're not seeing the right trajectory, there's something that's really standing out for us. There are other funds out there that we can do, that we can be excited about, and we should probably drop that fund and add something else.
Yeah, it's so true. When we look at even direct investments on our side, there's things that we like are okay, kind of like, feeling towards, but there's like something else that's keeping us engaged because maybe it's a pain point that we've personally felt with, or the solution seems pretty novel or unique. But if we're just not excited and our gut's not really in it, then we just have to say no to it and maybe come back to it at a later time when we get more excited about it if something's changed. So I completely agree with it. It's like, the KISS methodology. Just keep it simple. If you're not excited, just say no and move on to something else that gets you really excited, because it's a 10-year plus journey, as you know, as an LP in funds, and just like it is for us in direct investments, and there's no way out. So you got to be excited to it if you're going to marry someone on the first date. So thank you for sharing that. Before we wrap things up, we always like to ask our guests for their fast favorites. So first off, your favorite podcast.
And to go back to your, the whole person side of this, I know I've listened to your podcast, and a lot of times it's all about business. For me, I do podcasts that are outside the business side of things. So I like Cocaine and Rhinestones. If you guys haven't listened to it, it's much more sort of an academic understanding of country music. And I'm not a huge country music fan, but I like the histories and the stories and the relationships basically behind that. There's another one called The History of Rock in 500 Songs. And he basically does a song each week and basically goes into the history behind it. I'm just a sucker for some of these academics into pop culture sort of podcasts.
I love that. First, you're totally a liar because you're wearing a plaid shirt and you've got a long gray beard. So to tell me you're not a country music fan is a total flat out lie. But secondly, I remember as a kid, my favorite band growing up was the Tragically Hip. And there was a website that broke down every single song that they wrote and why they wrote it and all the hidden messages behind it. And I was obsessed with it. I love when pop culture meets that academic stuff as well. So thank you for sharing that.
Oh, there's a Canadian riff, Tragically Hip. Come on, Shadowy Men on a Shadow Planet. We'll talk about Canadian rock at some point. And now I know I have something else to talk to. So,
that's amazing. All right, I we know Geddy Lee too. Actually, he plays at our tennis club.
So, there we go. Yeah, yes,
we know Rush. There you go. Second one, favorite newsletter or blog.
Again, I like Dave Pell's Next Draft. I mean, it's sort of he calls himself the editor of the internet, and I just like his tone. I like his stories basically behind things. It's a quick, easy read. There's a bunch of other ones that I read about VC, about LPs. We all get. We all get Axios and Dave Primack and all these other, all the ones we actually read. But that's the one that I think again, to sort of say it's different than the other stuff I read, and I like his tone and his voice.
I love it. Favorite tech gadget?
So, again, I'm a geek, so I like Raspberry Pis and single board computers. My house is full of single board computers. I'll buy any new ones, and I think that is the amazingest thing, basically, where I can spin up a computer to do almost anything, blocking ads, bird watching, time series. I've got a lot of these sitting around my house, and I commend my wife basically for putting up with all these little devices hanging around the house.
What's the craziest thing you've built on the Raspberry Pi?
The craziest. This thing is probably a time sheet, basically. So, not a time protocol. I use GPS basically inside my house. So my time inside all of my devices are basically synchronized to the GPS within nanoseconds of basically the real time.
You are such a huge nerd. I love it. That's amazing. God bless your wife.
I agree. Yeah.
That's amazing. Favorite new trend?
Favorite new trend. There's a couple of these, but work from home is an easy one. The one I actually like is sort of the comeback of the walking. I mean, I think it's socially acceptable to be walking around and in a meeting, and we're still listening, we're still engaged. I love that where I can actually get some exercise, talk with people, catch up, and I'm not being disrespectful. I'm actually using the time, and usually my brain works much better when I'm actually doing something. So I love those back again, and I hope those continue, and I hope people still, still accept that as not as a social acceptance.
Absolutely. The walk and talk is a great one. I actually had 3 calls the other day where I immediately said on the call, hey, I'm going on off video. This is just going to be mobile. I hope you don't mind. And all 3 of them said, thank you so much. I'm going to do the same. Just give me a sec to grab my headset and I'm going to walk and talk with you as well. And people really appreciated that. So I think more people should be forthcoming with the fact that like they need to get up from their desk and walk around and they're still productive. And the other side will reciprocate and feel just as good about it as well. So that's a good one for sharing. Favorite book?
Favorite book, and this one I'll actually lean back into business things. I like hard things about hard things. What A16Z basically built is amazing. Mark Andreessen, I used to, Netscape, I actually pitched in front of him before. So I always like what he writes, but, Horowitz's books are always amazing kind of it too. So that's sort of my go-to.
It is a great go-to. And last but not least, your favorite life lesson.
And again, this one I have to keep learning, but, play long-term games with long-term people. There are, times in my life basically where I've looked back and I've been playing a long-term game with short-term people or people that are thinking short-term. So I always have to correct myself. If they're playing a short-term game, I just need to walk away because I'm not playing short-term games. I don't want to play short-term games. I think that's not the way to do business. I'm just not built for that. I just don't want to do that. But people that are, and people are very successful at that, and sometimes you need to partner with them, but I don't want to be, playing games with those people.
Wow, that's a great one. I've not heard that one before. And it really does resonate with a lot of the things that I think about when people told me like why I was getting into venture. I said, I really believe in it and I'm passionate about working with founders. But I said, I also know that this is going to take me like 25 years to actually see the fruits of my labor on it. And I was totally accepting of that, where a lot of people may think about it as short-term gains and short-term, relationships. It kind of reminds me of the Warren Buffett quote. I'm going to screw it up a bit, but it's like, if you have to get in line to make an investment, get the hell out of line. You shouldn't have to really stand there and waiting for someone to take your money because it's probably not really going to be a great opportunity at the end of it. That FOMO methodology as well. So I really like that one. Thank you so much for sharing that. And thanks for joining us in the tank today with Jeff Rinvelt, partner at Renaissance Venture Capital.
Thanks, Matt. It's been a pleasure.
Thanks for listening to another episode of Tank Talks. To learn more about this episode, be sure to go to Apple Podcast or Spotify to find more detailed notes on this episode or to check out previous episodes. Also, if you enjoyed this episode, please leave us a review and a rating as it helps us out a lot. And hit that subscribe button so you can get notified when new episodes come out. Finally, make sure to give me a follow on Twitter at Matty B. Cohen or at Tank Talk Podcast to stay up to date on new episodes or to be a guest on our show. Till next time,